Good afternoon, Travis and Brandon here with Home Ladder. Today we're excited to present to you the first market update for 2024. This is going to encompass the final month of 2023, all the important data out there for real estate investors and landlords. So let's dive into it.
Okay, so let's start with the real estate market. Cromford is putting out great reports every single month. They're dissecting Armless and really diving into the data, so it helps us kind of stay ahead of the curve and what's coming. Looking at this month's report, the balance market did not last long, 7 weeks to be exact. So as word of the Federal Reserve dropping interest rates comes, we're already starting to see some changes to the real estate market. So what that means is we have a handful of markets transitioning to a seller's market. So as you can see here, Tolleson, Apache Junction, Fountain Hills, Chandler, Gilbert, Levine, handful of others. While we still have just basically the outskirts of the Phoenix Metro remaining as a buyer's market. So Cave Creek, Gold Canyon, Queen Creek, Sun City, Casa Grande, Buckeye, and Maricopa. And then more of the core of the city kind of still in that balanced state. But as we continue to progress through 2024, it does appear that most of these cities are going to be transitioning into sellers markets again.
Yeah, it makes a lot of sense. So the markets where the home builders have available land and can put up new structures, that's more of a buyer's market. But then in the inner core where you've got limited supply coming on the market, then it's the sellers have the advantage, right?
Exactly. It's like a lot of folks have been interpreting the slowdown as like we're going to see a real estate market crash, but that's not the case when there's no supply there. Like obviously with interest rates, most homeowners are locked into really low interest rates, and they're not going to sell their home to go get into a higher payment, right? So this low supply is really keeping our real estate market alive right now.
Yeah, wow. Supply and demand works.
It works. All right, next we'll move over to Cromford's daily market snapshot here. So you can see this graphic, super useful. We can compare today to last month and then last quarter and the last 2 years. So interesting to follow some of these trends. First, active listings here. You can see we're trending up on this. So as we're talking about transitioning to a seller's market, overall, the data, we're at 18,000 active listings compared to 17,000 last month. 2 years ago, we were at just under 9,000 active listings. So crazy to see how many more properties are on the market right now.
Those were crazy days. 8,500 listings across all of the Phoenix Metro.
Yeah, that's a ton. And you can see the volume was there. So sales per year 2 years ago, 110,000, whereas today we're at 72,000.
Yeah. Well, even days on market sales, look at that. 67 days currently. 2 years ago, it was 36 days. Like, that was just historically low. Now we're back to just more normal 67 days. Like, that's what sellers should expect.
Yeah, COVID brought on a rush of craziness. We're leveling out, though. And then I love this average sales price percentage to list. So, again, going back to 2 years ago, you could see 99.7% were getting the price that they listed it at. Compared to today, we're at 97.36, which is pretty stable over the last quarter, last year. So
yeah, definitely. Brandon, one news story that we've seen over and over again since COVID is that evictions are soaring and they're through the roof. What does the data say here in Phoenix?
The data does show that evictions are up, but it's all in how you interpret that data. So if we look at the numbers here, 217,000 eviction filings since March 15th of 2020. Sounds pretty scary. 83,000 filings in the past year. And again, we got 7,100 filings in the past month. So that's 134% over the average. But the average compared to what? So during COVID, we had an eviction moratorium where no evictions were allowed whatsoever. So we saw evictions drop to basically nothing during that time frame. The eviction moratorium's over, so there were some folks left in those homes that had to be accounted for where evictions were getting pushed through that have been kind of delayed. And then population growth here in the valley, right? We've continued to have about a 1.5% growth in our Phoenix metro area year over year, so it makes sense that the volume is going to increase. According to this, we've got 14% eviction filing rate. Now, this is an aggregate over the last year. So 14% of leases secured are having evictions filing. Now, we see that's a much lower rate in single family homes, of course. You're seeing lower income, lower qualifications coming into some lower multifamily homes. Single family seems to be holding much stronger than that.
So what you're saying is the numbers are up, but they're not up at an alarming rate, and it's still a manageable risk for most landlords.
Absolutely.
All right, next we're going to talk about the rental rate for houses specifically. We get a lot of calls from investors that say, hey, I want to invest in Phoenix. And my first question is, well, do you know the Phoenix market very well? Because it varies widely across the metro that is Phoenix. Like if we We use reventure.app as our data resource for rents, specifically for houses. We think they have the best data out there. And if you look, like this is a heat map of the market in general, and rents can range widely across the valley. So when you go up to North Scottsdale, up in the nice suburbs near the mountains, like you're seeing rents as high as average rents. This is at $3,400 a month for rents up there.
Wow.
Whereas then if you come into more the inner city, you can get down to $1,600, $1,500, and these are for houses. So that's fairly affordable still. So it varies widely across the valley, and we love this heat map when we're talking to new investors of, hey, where would you like to park your money, and what market do you think has the best long-term appreciation and cash flow possibilities? Another metric we love to look at for investors is cap rate, right? That tells you how much gross income are you producing versus what did you pay for the property, right? Like what's your return on investment is the way to think of that. And that varies widely across Phoenix as well. As you look at this heat map, you can see there's certain areas where 2.3% is the cap rate for an area versus if you go to some of these other areas, you can get 5.5%, maybe even 6% in some zip codes. So it's a function of supply and demand, like always.
What areas in the valley are you seeing as the best cap rates right now for active investors?
I think for active investors, the best chance of achieving a high cap rate is probably in the far-flung suburbs, really. It's where they can get the best deal from the builders, where you can still buy available inventory and then rent it for a decent amount. So that's where we're seeing the best cap rates.
And we see those rents are appreciating a little bit quicker than what they are in the inner parts of the city.
Yeah, definitely. And you get a newer home with less maintenance. So
Right.
A lot of big benefits to buying in those areas.
Yep.
Another metric we love to look at when we're trying to decide what makes a good rental investment is affordability for an area, right? Like how much rent can the average family afford based on their income? And it varies widely throughout the valley. You have some areas with affordability as low as 20%. So their rent is 21% of their total income, which is very affordable. There's areas in the country where that's closer to 50 and 60%. Can you imagine spending 50 or 60% of your income on your rent amount? Like,
that's tight living.
How do you afford groceries? I think that's what makes Phoenix so attractive for people that are relocating here, right? Because you can still get a house, you can afford a house for your family and not have to work a second job to afford the groceries. So yeah, it varies widely across the valley from 21%, whereas if you go even into the most expensive zip codes, 33.85% is the highest that I see on this heat map. So that's still very affordable.
That's great. I'm sure if we looked into the data, we could see a correlation too between the higher that percentage goes, the higher the eviction percentage is going to be as well.
Oh, definitely. Yeah. You're operating on a shoestring budget, essentially. If one thing goes wrong, you're going to lose your house.
Yeah, one emergency and you can't pay your rent.
Yep.
I know one thing that's really important to our investors is rent growth year over year. Phoenix is a market that is great to get into, but you're not necessarily going to cash flow in year one, year two. So really looking at that rent growth rate to see, okay, when is it going to pencil out for me to cash flow on an investment property? Before COVID, we had seen like average 3% year over year growth rates. During COVID, we saw jumps of 30% year over year increases. Like that's obviously not sustainable. I'm imagining there's a slowdown. What does the data show? Yeah, well, it goes back to the affordability, right? I think we hit the max in terms of what people can afford. So the growth rate has definitely slowed down. We're seeing 1.03% as the year over year increase in rents throughout the valley. So you're still getting an increase, which the news media would lead you to believe that rents are falling, which they are in multifamily. But in single family, it remains strong. Under inflation, actually. So it's helping solve that affordability problem, but still allowing you to increase your rents a little bit. That's great data when having an annual strategic conversation with an owner, right? Like, okay, this is what rents are doing. It doesn't make sense to be aggressive with a renewal increase here because it makes sense to keep that property occupied, keep rents in line with the market. So great data to use for that. Yeah. Oh, let's talk about recent news articles that have come out, especially in the SFR world, single family rentals, right? The biggest news that I've seen so far in January is Blackstone acquiring Tricon. Back in the single-family investment market, huh? Back in it, right? So Blackstone started out in 2011, 2012. They were critical to turning the housing market in Phoenix around. They came and started buying up properties left and right, using those cheap interest rates to finance the acquisition of thousands of homes. What eventually became Invitation Homes, which is now 80,000 doors strong.
A couple years ago, they sold their stake in Invitation Homes, and everyone was like, okay, so does Blackstone not believe in the single family rental market anymore? Well, the news that came out this week, it confirms they are still definitely interested in the single family home market. So Tricon was one of the biggest operators in the country. They had 40,000 doors that they owned under management. So Blackstone coming in and acquiring them, big news, right?
That's
I think as we look through here, there's now three big players in the market. There's Blackstone, there's American Homes for Rent, which has 60,000 doors, and then Invitation Homes, which has 85,000 doors. So we're seeing a big consolidation of the market. The smaller players are going to get gobbled up by the bigger players that have the stronger balance sheets. So it's going to be interesting as we continue to watch this.
That's a great segue. I think there was some other interesting news about Invitation Homes in the news recently.
Oh, definitely. So yeah, this one came out as well at the beginning of the year here. Invitation Homes announced a new business, basically. Originally, they were formed to manage their own homes, right? They bought properties and then managed their own portfolio. Now they've decided to get into the third-party management game. So they recently announced in a press release that they are taking over a portfolio of 14,000 additional homes that are third-party management. So they're not going to own them. They're just going to act as the manager like HomeLadder does. So it'll be institutional money that they're most likely managing for, but huge news that they are now entering third-party management. The scale that they have in some of these geographic markets allows them to deliver maintenance at hopefully a cheaper price for these investors.
Hopefully, and 14,000 doors, that's a lot of homes. Is there any news on if that's coming from one source or multiple sources?
They were very vague in the article of where these came from. They say they're just portfolio owners. So we're kind of curious, is that a portfolio owner of one or two doors, or is this other big hedge funds that have maybe 500, 1,000 doors? So it's still unclear. They're a publicly traded company, so I think they have to be a little more tight-lipped until the deal is probably officially signed. But the press release says they're moving forward with getting into the third-party management. So
It's definitely one to keep a close eye on over the next few months here.
definitely. Wall Street has decided they want to be your landlord.
In other news, Tempe is the latest to join Tucson and Phoenix as adding source of income as a protected class. So essentially, landlords no longer have a choice. They must accept housing choice vouchers, or Section 8 as most people know it.
What are those?
Essentially, those falling below a certain income threshold are qualified for government assistance to pay for their housing. So based on their income, they get an allotment of how much they can spend based on their family size. So it's not them paying the rent, it's the government paying the rent on their behalf. So obviously pros and cons there. Guaranteed income from the government is a solid. What most landlords are a little bit worried about is there are some trends of perhaps the properties not being as well maintained just because they don't have any skin in the game.
Yeah. I know from a landlord and property manager's perspective too, I was really scared last year when Phoenix passed this because they had a notoriously awful Section 8 department that was just hard to get a hold of. It would take months to get an inspection scheduled, which it's a key element of getting your housing voucher approved. So the fact that they were now requiring it made me fearful, like I'm going to have homes sitting on the market for months and months waiting for an inspector to come out. But we went through our first one just a couple weeks ago, and they were so prompt. They were on top of it. They had hired an outside company to facilitate the Section 8 program, and it worked really well. Like, it was an efficient system. It should be a win-win for landlords and tenants. How do you feel, though, about the government forcing landlords' hands on this?
It's an assault on property owners' private rights.
It is. Yeah, definitely. Let the free market decide, right?
Every year, our governor lays out a State of the State address. 2 weeks ago, Katie Hobbs delivered her State of the State address. There's two big priorities here that really drew my attention in terms of real estate. So one being water. Arizona's assured water supply, or lack thereof, has reached levels of critical concern and will be addressed during this legislative session. The other is housing supply, like we talked about earlier. Really low housing supply is what's been keeping our market alive, but it's creating some other issues.
Yeah, definitely. Well, in terms of water, I was so impressed when I moved here from Illinois of the links they go to here to make sure that we have a water supply for new developments. So, for example, before you build a new neighborhood, you have to prove out a 100-year water supply for that neighborhood. And that typically means buying the water rights from the previous farmer of the land. And everyone knows that homes use a lot less water than farms do. So as we take over farms with subdivisions, our water supply actually increases over the long term. So they've got a good long-term strategy for that. One thing I learned this year or in 2023 though is that like a carve out for that requirement is these build for rent communities. They're actually exempt from the 100-year water supply. So a lot of builders figured this little nuance in the law out, and they started, instead of building homes for sale in a big neighborhood, they built entire neighborhoods that were just set up for rent to get around this law. So that way they could build the neighborhood and potentially sell those water rights to another developer for another area. So maybe they'll figure out a way to close that loophole that people have been exploiting.
Interesting. So it's almost like the two are in conflict of each other, right? Like this is water rights are infringing on their ability to create housing supply.
Exactly. These built for rent communities are perfect for creating new supply for people that want a brand new construction home with the privacy of a home versus an apartment. So yeah, it's going to be interesting to see how the legislature and the governor work this out and focus on these two priorities at the same time.
Yeah, we see these build for rent communities popping up all over the valley right now.
Definitely. Man, Brandon, we just got through our first market update. It was kind of intimidating. We covered a bunch of stats, a bunch of news stories. What do you think the audience is going to think of this?
I hope they like it. It was fun for us to do. I think this is a great way for us to stay in touch with what's going on in the local market and stay in the know for our investors. And I look forward to continuing to put these out every month.
Yeah, definitely. Well, if you enjoyed this as well, feel free to click like or subscribe below and make it a great day.